Okay, in this lecture, we're going to study Chapter 2, Financial Statements and Cash Flow. So after studying this chapter, we want to be able to understand the difference between accounting income and cash flow. Cash flow is defined as the difference between the amount of dollars that came in minus the number of dollars that went out. Dollars in minus dollars out. And accounting income, which you can find in the bottom line of the income statement, does not really reflect cash flow. So in this chapter, we're going to learn how to determine a firm's cash flow from its financial statement. So specifically, we're going to need balance sheet and income statement. So let's look at the balance sheet. So the balance sheet looks like this. So balance sheet is like a snapshot of what firm owns, its assets, and what firm owes, its liabilities, and the difference between the two, which is owner's equity at some point in time. The most important thing about the balance sheet is that the balance sheet has to balance, meaning that the value on the left side must equal the value on the right side. So for instance, let's say you own a car which is worth $20,000. And when you purchase the car, you took out a loan. The remaining balance is, let's say, $15. Then equity would be, excuse me, $5,000. So that's a very simple balance sheet. So in this balance sheet, as you can see, equity represents the residual value, meaning that if you sell your car on the market for $20,000, then you can use $15,000 to pay off your loan, and the remaining $5,000 goes into your pocket. So in this sense, equity represents residual value of your assets. Another concept that I want to talk about is net working capital. So there are two types of assets. There are current assets and there are fixed assets. Current assets have economic life of less than 12 months. And fixed assets are more for the long term. And liabilities also have two types. Current liabilities and long-term debt. current liabilities must be paid off within 12 months. So it's short term. And net working capital is the difference between current asset and current liabilities. So this is net working capital, the difference between these two. So net working capital will be positive if the cash that will be received over the next 12 months exceeds the cash that will be paid out over the same time period. So in the healthy form, net working capital is usually positive. So let's look at the income statement, which looks like this. So income statement is more like a video of the firm's operations for some period of time. So it lists revenues in the top line here, and profits in the bottom line here, and for the cost adjustment in between. The word here, period of time, is very important. In economics, the variables like we can find on the income statement are called flow variables. So for instance, in a bathtub, if you turn on the water, then water will flow into the bathtub. And the flow variables, as the name implies, measures the amount of water that flow into the bathtub over some period of time, let's say 1 minute. In contrast, the variables that you see on the balance sheet are called stock variable. So it represents the stock of something at some point in time. So in the best of example, so stock variable would measure stock of water that is in the bathtub at some point in time, let's say at this point. In the income statement, the most important thing about the income statement is the GAAP, generally accepted accounting principle. So income statement must show that revenue as it accrues. So revenue must be recognized at the time of sale. So for instance, let's say you make some product. Some production happens in, let's say, 2017. So you spend $200 to produce a product. And a few months later, in 2018, there is a sale of that product for $300, but sale is made on credit. Then a few months later, sometime in 2019, you receive the payment on the sale. So there's cash inflow. So even if the cash inflow takes place in 2019, you must recognize sale, the revenue at the time when sale was made. So in the income statement for 2018, so this revenue will be recognized for 2018, not for 2019. Also, the expenses shown on the income statement must be based on what is called the matching principle. So you have to match revenues with costs associated with producing them. So the production happened in 2017, so you don't expense this $200 for 2017. You wait until the sale is made. So in the meantime, you put that on your balance sheet as inventory. So in 2018, the sales is made, then this inventory goes off the book and move on to the income statement and recognized as cost of goods sold for 2018 to match revenues with cost. But the cash outflow took place in 2017. So as you can see, the numbers shown on the income statement may not be representative of the actual inflows and outflows that occurred during a particular period of time. So we're going to learn how to adjust for this. Another important thing about the income statement is non-cash items, such as depreciation. So it's a primary reason why accounting income differs from cash flow. And the depreciation deduction is another application of the matching principle. So let's say that you do a video game business. And so you invite your friends over to your place and let them play video games and you charge for it. So at the beginning of this year, you purchased 2 PS4 consoles and you spent $600. You paid in cash. So there was a cash outflow. But instead of the expensing, recognizing this cost immediately for 2020, you first think about how long these PS4 consoles can generate revenue. So let's say if you decide that the PS4 consoles can generate revenues for your business over the next 3 years, then you recognize this cost over the next 3 years. So 200, 200, 200, in order to match revenues with expenses. So how it works is that you first put this on your balance sheet. This is in the fixed asset. So PS4 console, 2 of this, which is worth $600. So $300 each. That's your balance sheet at the beginning of 2020. And your income statement for 2020, you recognize this cost as depreciation. Of $200 depreciation expense. Then at the end of 2020, on your balance sheet, the fixed asset actually is net fixed asset, net of depreciation. So net fixed asset is going to be $400. So 600 minus $200. So in this lecture, we're going to learn how to separate the cash flow from its non-cash accounting items like depreciation. So now it's time to learn cash flow. Again, cash flow is the number of dollars that came in minus number of dollars that went out. So it's one of the most important pieces of information that a financial manager can derive from financial statements. And unfortunately, there's an accounting statement called the statement of cash flows. But this statement of cash flow does not really provide us with kind of information that we're interested in here. We're going to look at how cash is generated from the assets and how it's paid to those that finance the purchase of these assets. So let's consider a firm. Firm has assets, and using the assets, firm generates dollars through its business operations. So this cash flow is called operating cash flow. So cash flow from firm's business operations. But some of these cash flows must be reinvested in the firm for future growth. And the remaining cash flow after this reinvestment is called cash flow from asset. So cash flow from asset has several pieces. So we're going to study each component at a time. So first, let's look at operating cash flow. OCF, operating cash flow, is a cash flow that results from the firm's day-to-day activities of producing and selling. And when we're calculating the expenses, we want to exclude depreciation because it's not a cash outflow. And also we want to exclude interest because it's a financing expense, not an operating expense. But we do want to include taxes because taxes are paid in cash. So operating cash flow is revenue minus cash operating expenses. Because it's cash operating expenses, so it excludes depreciation, and also exclude interest expense, but include tax expense. So that is operating cash flow, or OCF. And you can start from earnings before interest and taxes. So it's before interest and taxes. So it excludes interest expense already. So we add back taxes as an expense, right? But EBIT is revenues minus COGS, in our example, minus depreciation. So that is EBIT. So we add back depreciation to undo this. Okay? So that is operating cash flow. So let's look at our example to see how this works. Let's move up here to see the income statement. Okay, so I'm going to make some space here. So operating cash flow is defined as EBIT plus depreciation minus interest. So EBIT, or operating income, is here. It's $694 million. If the numbers on the screen are too easy to see, then please see our lecture notes. And depreciation can be found here. So we add back 65, and interest here. No, excuse me. Is here. Oh, sorry. We don't want to include interest. We have to include taxes. Taxes are here. The taxes minus 131. So again, so operating cash flow is defined as EBIT plus depreciation minus taxes, not interest. So this is, I believe, is $628 million. So that is operating cash flow. Okay. So this is operating cash flow. $628 million in our example. And some of this operating cash flow must be reinvested in the firm. And there are two types of reinvestment. Just like there are two types of assets. So there are current assets and there are fixed assets. The firm must reinvest in fixed assets, and also must reinvest in current assets. So let's consider investing in fixed asset first. Investing in fixed asset is called net capital spending. So net capital spending is simply money spent on fixed assets less money received from the sale of fixed assets. So we can start by looking at the change in net fixed asset. So here, capital data represent change. So net capital spending is change in net fixed asset, and you have to do some adjustment. You have to add back depreciation. So that is net capital spending. And net capital spending is often called CapEx, which is short for capital expenditure. So net capital spending and CapEx mean more or less the same thing. And let's see why we have to do this depreciation adjustment. To see this, let's go back to our video game example, which is here. So let's say during 2020, so the first scenario, you make zero net capital spending. So you do not buy additional PS4 consoles, or you do not sell any of the existing PS4 consoles. Then net capital spending should be zero. But if you look at the change in net fixed asset, which is $400 minus $600, this is negative $200 because of this depreciation. Here, depreciation has been deducted out already, but there is no net capital spending. So this negative $200 comes from depreciation. So we add back this $200 of depreciation. Then net capital spending is indeed zero. Okay. In the second case, let's say during 2020, you buy additional PS4 console, which cost $300. There's a second scenario. So there are 3 PS4 consoles, so we have to add $300. Now your net fixed asset is going to be $700. So 2 old PS4 consoles and 1 new PS4 console. So net fixed asset is $700. So in the second case, change in net fixed asset is 700 minus 600, so positive $100. So if we add back depreciation, your net capital spending going to be $300, which is this. Okay. And net capital spending could be negative if you decide to sell some of your asset. Let's say business is not going very well, so you decide to sell one of your PS4 consoles. You can sell it at, let's say, $200. So net capital spending is minus $200. So you made this investment. So you subtract 200. Then net fixed asset is going to be $200. So in the third case, change in net fixed asset is going to be 200 minus 600. So it's going to be $400. So if you add back depreciation, the net capital spending is $200. So in a growing company, you see net capital spending is usually positive. But this can be also negative as well if firm decides to sell some of its assets, some of its fixed assets. So second type of reinvestment. So in addition to investing in fixed assets, firm must also invest in current assets. But when the firm changes its investment in current assets, its current liabilities will also change as well. Okay, so you have to adjust for the change in current liabilities when we are thinking about investment in current assets. So investment in current asset is change in current asset, and you have to adjust for change in current liabilities, which is equal to change in net working capital. So that's reinvestment in current asset, or equivalently net working capital. Okay, let's see our example. See how this works. Okay, so I'm gonna make some space. So let's consider net capital spending first. Net capital spending is change in net fixed asset minus, plus depreciation. So depreciation can be found on the income statement. So down below here, depreciation is 65. Okay, so that is 65. And change in net fixed asset, we have to see here. Net fixed asset is here. So change in net fixed asset is 1709 minus 1644 plus depreciation 65. Okay, so net capital spending is, I believe this is $130. Okay, how about the, okay, which color I want to use? Okay, so change in net working capital. If you have to compare net working capital at the end of 2018, the difference between current assets minus current liabilities. So for 2018 numbers is 1464 minus 389 minus 1112 minus 428, which is here. So change in net working capital is going to be $391. So you can combine all of this. So cash flow from asset is operating cash flow minus net capital spending minus change in net working capital. So operating cash flow is here, $628 million, and net capital spending is here, 130, and change in net working capital is here, 391. So I believe this is $107 million cash flow from asset. Okay. So in our example, so operating cash flow was $628 million, and net capital spending is $130, and investment in net working capital is $391 million. So the remaining $107. Excuse me. Okay, it's here. The remaining $107, which is cash flow from asset. So let's summarize. So operating cash flow was 628, and you have to reinvest some of it back into the firm as investments in fixed assets and net working capital. So remaining $107 million will be cash flow from assets. And this cash flow from assets is sometimes called free cash flow. So it's free in the sense that it can be distributed to creditors and shareholders or stockholders. So this can be distributed to the firm's creditors and stockholders because it's not needed for working capital or fixed asset investment. Okay. So we have this cash flow identity. The firm generates cash flow through its various activities, and that cash flow is either used to pay creditors or pay out to the owners of the firm. So let's first consider cash flow to creditors. So here's a firm, and there are creditors. So obviously, firm pays interest. And also, firm may pay off some old debt. So firm may retire from old debt. But firm may also issue new debt. So borrow some money. Okay. So creditors, so cash flow to creditors is interest paid minus net new borrowing. Okay. That is cash flow to creditors. Similarly, cash flow to stockholders is defined in a very similar way. So you can replace interest paid with dividend paid and net new borrowing with net new equity raised. Then you have cash flow to stockholders. So let's look at our example. Okay, so interest paid is $70. Cash flow to creditors interest minus net new borrowing. Interest was 70. So net new borrowing is change in long-term debt. So we have long-term debt here. That's net new borrowing. So 454 minus 408. 454 minus 408. So cash flow to creditors is, I believe this is $24 million. Okay. And how about cash flow to stockholders? It's defined in a similar way. So dividend minus net new equity raised. So dividend can be found in the income statement. Let's go to the income statement. Dividends is here. So net income was 493. So from pays out, use some of it to pay out to stockholders, and the rest of the net income will be added to retained earnings. So dividends is 123. So dividend is 123. Net new equity raised is, can go to the balance sheet. You can look at common stock and paid in surplus item. So net new equity raised is 640 minus 600. The change in two numbers here. So 640 minus 600. So cash flow to stockholders is $83 million. And there's another way, alternative way to calculate cash flow to stockholders. So let's go back to the income statement. So again, so net income 493, and some of it is paid out to shareholders, so as dividends, and the rest of the net income will be added to retained earnings. So here, so total equity changes because firm may issue new equity, also because firm add retained earnings. So alternative approach will be useful if we don't have detailed information about total equity. We only know the total equity number. Okay. So change in total equity will be change in retained earnings plus net new equity raised. So net new equity raised is change in total equity minus change in retained earnings. So to summarize, so cash flow from assets is operating cash flow minus net capital spending minus change in net working capital. Also, this must be equal to cash flow to creditors plus cash flow to stockholders, which is 24 plus 83, which is 107. So these two identities hold. So this is used to check whether to see if you have computed everything correctly, or if you can compute cash flow to stockholders if you know cash flow from assets and cash flow to creditors then you can back out cash flow to shareholders, because the cash generated from asset must be either used to pay creditors or paid out to the owners of the firm. Okay, so I think that should do it for today's lecture. Thank you for watching. I'll see you next class.